Hi, and welcome to Technically Speaking Tuesday. I'm Lance Roberts, Chief Financial Strategist for Clarity Financial with your Technical Tuesday update. We're going to talk a little bit about the markets today from a irrational exuberance level. First of all, the markets are rallying just a little bit today. Again, kind of following through yesterday's kind of lipid rally on the idea that trade wars and trade concerns have now been resolved. Markets still remain very range-bound within their long-term peaks here. Really over the last 3-4 weeks, we haven't gone much of anywhere, but we are looking for a continued rally through the end of the year as strong fundamentals still play the game here currently. But what we want to talk about today is, have we gone too far in terms of expectations? So with that being said, let's jump right into the story today. You know, when we talk about irrational exuberance, clearly sustained low inflation implies less uncertainty about the future, and lower risk premiums imply higher prices of stocks and other earnings assets. What that simply means is that when you have low inflation and low interest rates, that should theoretically lead to higher asset prices. Well, and that's the way it's worked throughout history. In fact, when we do this, but how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions as they have been in Japan over the last decade? Interestingly enough, that was said by Alan Greenspan in 1996. The famous line, irrational exuberance, was as asset prices were moving into one of the fastest, steepest, sharpest rises in U.S. history from 1996 to 1999. Of course, that was the peak of the dot-com bull market exuberance at that point, of course, led to the dot-com crash that shortly followed. But as we look at this, are we once again seeing very much the same things in the markets today? You know, interestingly, the market since the election has had a very, very strong advance. And of course, we've had 3 massive hurricanes. We had 2 major wildfires, billions in funding being put to work since the beginning of this year. And you'll notice right here the steep decline in the deficit starting in October of 17. By the way, this is when the hurricanes hit and we began funding for solving a lot of these hurricanes, wildfires, etc. A sharp decrease in an increase in the deficit, money being flowing into the economy, of course, combined with tax cuts, has led to this continued rise in the markets, of course, over the last several months. And again, expectations are currently that, well, this will just continue because earnings are fantastic. Well, earnings are fantastic because of tax cuts. And of course, a lot of the issues are with repatriation of dollars going to share buybacks. Let me show you an example of something here. This is reported earnings for the S&P going back to 2014, and this is the cumulative percent change in earnings. So in other words, in 2014, the cumulative percent change in earnings was about 2.5% back there. It then slowed down in 2015-16 when we went through kind of the weak economic environment beginning in 2015-2016, known as taper tantrum, and that was as the Fed was raising interest rates. Earnings started to recover in early 2017. Of course, when we got the tax cut boost, we saw this big jump in earnings per share on an after-tax basis. In other words, the tax cuts provided a huge boost to corporate profitability, of course, combined with some of the sharpest reductions in share backs in U.S. history, over $1 trillion worth of buybacks slated for this year alone. But let's take out the tax cut for just a moment and look at where profit growth is pre-tax, right? So now we're looking at the profits before taxes are taken out, and all of a sudden we see a very different picture. We've had a 55% cumulative rise in the S&P since 2014, yet only a 6.7% increase in the underlying profitability of companies. So in other words, it's very hard to justify a 55% increase in asset prices with only a 6.7% profit growth before tax. So the question now becomes longer term is that, remember, value is what we pay or what we get with the prices that we pay. So whatever we pay in price, we're paying for future value. And as you'll notice, when we take a look at profits divided by GDP, in other words, real inflation-adjusted profits divided by real GDP growth, whenever that has exceeded, and currently we're at the second highest level on records, whenever that has exceeded its long-term trend, well, we've run into problems within the markets historically. Back in the 60s and 70s, it was the bear market, the dot-com bubble, financial bubble, the central bank bubble that's going on now. Those were the only points in history where profits as a percentage of GDP exceeded their long-term trends. The best opportunities to invest is when that has been below the long-term trend. Of course, the 80s and the 90s, and then beginning in 2009, we had a nice rally. But we are once again back to very expensive levels. And why? Because we've had an unduly long period of low inflation rates, low interest rates, of course, massive amounts of Federal Reserve and central bank interventions globally. The issue becomes, as we look at this trend has continued in a very straight pattern. Now, this goes back to 2011, just coming off the financial crisis, and you can see where Ben Bernanke launched QE3. You can see here in 2015, 2016, where central banks took over the funding of the markets and really took over the central bank interventions from the Federal Reserve. We started a very increased slope in terms of the price appreciation of the markets. Of course, tax cuts came in here. And again, while we give a lot of credit to tax cuts as to boosting asset prices, this has really been a facilitation of central bank interventions on a global basis. Tons, trillions upon trillions of dollars of liquidity being injected into the markets, and in some cases, in the case of the ECB, Japan, directly into assets themselves. And of course, the difference now is that as we talk about these elevated asset prices, markets have gone up. We're all very exuberant about this. Consumer confidence is at record levels. Investor confidence, very, very high. The number of people concerned about a crash, non-existent at this point, but yet we are now at a point to where central banks globally, and you can see here whether it's the ECB, the People's Bank of China, the Bank of Japan, or the Federal Reserve, all of the major central banks, the major players, the ones putting money into the markets in terms of these global central bank supports, are now all reducing their balance sheets. In other words, they're extracting that liquidity, the driver of the market, that liquidity that's driven these asset prices higher over the last several years, now being extracted from the markets at a time where interest rates are going up, global economic growth is weakening. This certainly suggests that there may be problems for stocks here in the very near future. What this chart shows you is simply a look at valuations and extensions of the markets, and the point here is very simple. Without getting into all the detail about excess valuations on the markets, extremely high deviations from long-term trends, the end result of all this is that the few times in history where the markets have been this extended, this overvalued, and this overbought, it has led to, well, basically not good outcomes for investors historically. Now, another way to look at this is simply the measure of the S&P 500 and its deviation, how far above or below its 50-week moving average. So we're looking at almost 1 year's worth of prices, a 50-week moving average, and looking at where the price of the market is in relation to that 50-week moving average, how big of a percentage move above or below that is. And where we are currently is that we are more than 200% above that long-term 50-week moving average, which is one of the highest periods in history. And every one of the periods in history where we have been at this level or higher has led to either a correction, some type of recession, or some type of financial crisis, because ultimately prices are a reflection of consumer sentiment and psychology. And when we get overly anxious at a time where interest rates and inflation and liquidity is changing within the overall environment and valuations extremely extended along with prices, you tend to set up an environment for something to happen that causes a reversion. Now, this doesn't mean that it's going to happen today or tomorrow or even next week. The point here is that the markets are not able to sustain these deviations for an extremely long period of time without having a correction like we saw in February of this year. So when we look at this, another way to look at this is that we take a look at prices, and this is simply a Bollinger Band analysis, right? So we're looking at two standard deviations above and below, again, the 50-week moving average. So you're looking at a very long-term moving average, 50 weeks, almost a year, and we are currently more than two standard deviations above that 50-week moving average. And again, when we go back through history, what we see is that every time that we are this extended, it leads to a reversion within the markets at some point in the future. The question now becomes just how big of a correction could possibly come out of this market if we get into a real extended sell-off like we've seen previously. First level of major support is back to the tops of 2015 and 2016, which would be almost a 28% decline from current levels. The next level support would be the lows of the 2016 correction 33% from here. And of course, the worst outcome is a recessionary decline that would occur during the next recession, which would potentially take us all the way back to the previous highs of 2007, 2008, a 46.9% decline. That would be a normal mean reverting event for a market that has been this extended for this long in this type of environment. So while this all seems very scary, that doesn't mean that any of this actually is a concern today or tomorrow or next week. But importantly, it is what we are watching for in terms of managing money, managing our portfolios to make sure that we can navigate any type of reversion to the mean when it occurs. The question is that whether it will occur. The question is only when. And to let you know that we are watching for this and we're prepared for it with our portfolios, our strategy. This is why we maintain trailing stops. We continue to hedge portfolios as necessary, and we are watching out for your money. So make sure and tune in to our daily podcast that we do every day on the website, realinvestmentadvice.com, or subscribe to our YouTube channel, and we'll let you know automatically by email when we post a new podcast each and every day. That's simply at realinvestmentadvice.com. Click on the podcast page. All of our listening options are there for the podcast. And of course, if you have any questions or comments, don't hesitate to give us a call or send me an email. I'm always happy to help you any way that we can. Realinvestmentadvice.com, Clarity Financial. I'm your host, Lance Roberts. We'll see you next time.